$600 billion in projected capital expenditure. A financial seismic shift redefining the infrastructure of the digital age, triggering a trillion-dollar market contraction while simultaneously fueling a singular, explosive ascent in hardware valuation. The architectural foundation of artificial intelligence is currently undergoing its most aggressive expansion phase in history. Reports confirm that Amazon, Alphabet, Meta, and Microsoft are collectively targeting a capital expenditure surge between $600 and $650 billion for the fiscal year 2026, represents a 50 to 60% increase from 2025 levels, signaling an unprecedented commitment to securing the computational domain required for future AI ecosystems. However, this massive allocation of resources has not been met with market optimism, but rather with acute volatility. Since January 28, the S&P Software and Services Index has shed approximately $1 trillion in value, driven by investor anxiety over shrinking profit margins and the nebulous timeline for a return on investment. Yet, amidst this widespread correction, one entity stands apart. Nvidia has surged 7%, its valuation validated by the very expenditure that is punishing its clients. Today, we analyze this divergence, dissecting the capital flows reshaping the technology sector. To understand the magnitude of the current market disruption, one must first comprehend the scale of the physical infrastructure being deployed. The big tech cohort is no longer merely developing software. They are constructing the electrical and computational backbone of the next decade. Amazon, Alphabet, and Meta are spearheading this acceleration. The projected spend is not distributed evenly across general operations but is heavily concentrated in two specific vectors: advanced data center construction and the acquisition of high-performance logic processors. This is a transition from general-purpose cloud computing to specialized AI compute capacity. Visual. Split screen showing Amazon's AWS logo and a falling stock chart, juxtaposed with blueprints of new energy-intensive server farms. For Amazon, the focus remains on fortifying OAs to support generative AI workloads. The market's reaction, an 11% decline following earnings reports, reflects a disconnect between long-term strategic necessity and short-term financial discipline. Investors are witnessing a reallocation of capital that depresses immediate free cash flow in favor of future capacity. This is not merely maintenance spending. It is an aggressive land grab for compute power. Alphabet and Meta mirror this trajectory. Their capital expenditure guidance suggests that roughly 3/4 of this $600 billion outlay is earmarked specifically for AI-related hardware and facility development. The strategic imperative is clear. In the race for artificial general intelligence, compute capacity is the primary constraint. By securing this infrastructure now, these entities aim to create an unassailable moat around their respective AI ecosystems. However, the sheer velocity of this spending has shocked a market accustomed to the high margin, capital-light business models of the past decade. The contraction of the S&P Software Index by $1 trillion signifies a fundamental re-evaluation of risk. The market is currently grappling with a profitability paradox. While the consensus acknowledges that AI is the future of the technology sector, the cost of entry has escalated to levels that threaten the immediate financial health of even the most solvent corporations. The panic stems from the timeline of monetization. The $600 billion flowing into GPUs and data centers is a tangible, immediate expense. Their vain wedge generated from these investments, however, remains largely theoretical or, at best, nascent. Generative AI applications, while impressive, have yet to demonstrate a profit margin profile comparable to traditional search advertising or cloud services. Investors are questioning the efficiency of this capital deployment. When Amazon or Alphabet announces a 50% increase in CapEx, the market mathematically adjusts for reduced earnings per share in the immediate quarters. This creates a friction point between the company's visionary long-term horizons and the market's demand for quarterly efficiency. The fear is not that AI will fail, but that the cost of building it will erode shareholder value for years before yielding a positive return. This anxiety is what drove the broad sell-off across the software complex, punishing companies that are prioritizing infrastructure over immediate margin preservation. In stark contrast to the broader sector's retraction, Nvidia's 7% surge serves as a direct validation of its pivotal role in this ecosystem. The market logic here is inverted compared to the hyperscalers. For Amazon and Meta, the $600 billion represents an expense. For Nvidia, it represents revenue. The massive capital expenditure plans announced by big tech are effectivizing the purchase orders for Nvidia's silicon. As the primary supplier of the AI accelerators essential for these new data centers, Nvidia is the immediate beneficiary of the infrastructure war. The market panic regarding big tech's spending confirms that demand for Nvidia SH100 and upcoming Blackwell architectures remains not just robust, but insatiable. This dynamic illustrates the pick and shovel theory in action. While the gold miners, the software giants, face the risks of exploration and excavation costs, the provider of the tools enjoys guaranteed demand. The 7% increase in Nvidia's valuation is a rational market response to the confirmation that the world's largest companies are committed to purchasing its product at an accelerating rate regardless of their own immediate profitability concerns. The infrastructure bet is, fundamentally, a bet on Nvidia's architecture. Looking ahead through 2026, the divergence between infrastructure providers and service deployers is likely to persist. The $600 billion figure is a baseline, not a ceiling. As AI models grow in complexity, requiring exponential increases in compute for both training and inference, the pressure on capital expenditure will remain acute. We are witnessing the formation of a new digital industrial complex. The entities that can sustain this level of investment without breaking their balance sheets will emerge as the operators of the future as intelligence layer. The market volatility is the friction of this transition-era calibration of expectations as the technology sector shifts from a software-centric growth model to a capital-intensive infrastructure build-out.